So I'm just going to start really talking about some of the key things that that we as investors look for, but I think more importantly, what a lot of other investors look for when they invest into a company and a set of founders, right? So there's a bunch of different things, and of course, entrepreneurship is where the innovation comes from, and so it's an important part of the investor spectrum to invest in early stage businesses. And investing in early stage businesses are significantly different than investing in late stage businesses. So what I'm really going to talk about is more early stage type businesses first. And during the presentation, I'd be very happy to answer questions as we go along. If you have a certain question, please just let yourself either tell a moderator or raise a hand or something, or maybe write something into chat, and one of the moderators can help, and I'm happy to answer questions as we go along. So look, I think the first and most important thing is when you ask the question, how do I take my business to the United States? And also when I say these things, understand I'm coming from the aspect where you're probably also looking for capital. What is it that an investor is looking for? And how can you partner with them? And that will be one of the key takeaways here. So the first thing that you need to think about is investors really want to see an experienced management team. So does this business founder really understand the industry that they're in? So we're going to go into that in a little bit more detail. But the first thing here, if you look at the slide, what are we looking for? And there's at least 5 core things. You need the experienced management team, number one. You need products or services that solve a problem. And you need to explain that. What problem is this solving? You're going to need to be able to understand the growth of that business. What's the size of that market and how are you going to attack it? Third, your internal systems and your ability to collect data. It's going to provide a lot of important information to investors that you have a handle not only on your business, but how you can manage it. And I think that was 4th rather. And the 5th is obviously what everyone wants to know about is what are the exit strategies? So I'll spend a little bit of time going through those kind of 5 core areas today. So as I was starting, experienced management teams. Does the business founder have deep experience in the industry? Of course, investors want to understand and know that you're coming from a place of deep industry experience and that you've learned a lot of lessons along the way. So that's really important. It's a lot easier for an investor to get comfortable with someone knowing that they spent 10, 15, 20 years inside of an industry. You know how it works, you know what makes it successful, and you know where the problems are. So that's really important. It doesn't always have to be. Of course, you could be a first-time founder in a business, but that's really much harder. Secondly, as a manager, do you have the ability to manage people? You're really building a team, right? Investors don't want to just invest with a founder. That's important, and it's very important, but does the business founder have the ability to build and recruit and retain a really solid management team that actually has industry experience? And that will help mitigate the risk. So the importance of building the team. And then at the same time, what's going to make that team stay in place? Does the business founder been able to create a set of incentives through compensation programs, profit sharing, equity sharing? Does the management team share in those incentives? And that's a really critical point. It's very easy to kind of get too greedy and just think you can pay employees a certain way, but you need to make sure that your core top management team has an alignment system that's similar to yours as the business founder. And that ensures that everyone's kind of rowing the boat together, right? And that's the best way that you retain people as well. So investors are going to want to understand that, yes, you're incented to stick around, but is the management team also incented to stick around? So that's a really important area. And it's important to kind of understand that in the early days when you're starting your business, or at least when you're presenting your business to investors. I don't want to get too much into details here, but you really need to think about your capital structure between your equity and your debt, and understand how you're going to be sharing the results of your success with your management team. And every founder is going to have different perspective of that, but you should be thinking about that early on. The last thing is, can the founder provide credible business references, right? Everyone is obviously going to be a passionate salesperson and probably a very convincing salesperson. But at the end of the day, does the business founder, do they have the ability, or she have the ability, to find and bring references to the table so investors can go back to that reference and check it out? So that's a really important key. Do they have a background that they can expose? Can they make calls? Are there people willing to advocate for that founder? So I think that's a really key area. So just to kind of summarize this page, you certainly can start a business without any experience in an industry. It's just much, much harder to get venture capital to back you if you don't have background in that space. So try to recruit management teams with industry experience, and you're well on your way to success if you have a deep industry experience on your side. So as you can tell, I started with management team and with a manager, because that's the most important thing. As investors, we're investing in people, right? Ideas are important, but at the end of the day, you're investing in people. And as the management, as the founder of the business, you're investing in your own people. So you understand that. So it's key to understand that the first thing investors look at is, who are we investing in? Do they have good character? Do they have good references? And do we like them? Second thing, which is the next important thing in this order, is what's the problem that you're solving? It seems very obvious, right? Of course you're solving some type of problem, because you probably wouldn't be in the business. It's another thing, though, to be able to clearly articulate that business problem. So it's important when you are pitching to investors in the US that you clearly articulate, what is the business problem that you are solving, and then exactly how you're going to solve it. A lot of time investors don't have nearly the industry experience that you do, and so they need a little bit of background. So the ability to clearly articulate and quantify the business problem that you're trying to solve for is absolutely key. And then once you've done that, right, the next thing is, can you show them existing customers? Now, some of you are very early stage businesses, and that's a little bit harder, but to the extent you have existing customers is really important. It shows the investor that you've done your work already. You've taken your product to the market somewhere. You have existing customers. In the early days, you should work with your customers to try to extract references out of them, right? Allow you to put their profile in your marketing documentation. That can be part of a contract. I would recommend that you think about that when you develop your contract, so you can use their names in your marketing materials. That will be helpful. It'll also be helpful to know that with your customers, you can kind of grow with them, and they can share with you the problems with your product and services as you innovate on it. So although there are investors that are willing to invest into a business without any existing customers, it's certainly going to be a lot easier if you have existing customers, and it's even better if you can have those existing customers be willing to talk to your investors. We often do that. When we invest with folks, we will talk directly to that founder's customers to understand how the business is solving their problem, and do they like working with that management team. So I think that's really key. And then of course you can solve a problem. That's not that hard to do, but to what extent are you solving it? Are you solving a little problem or a much larger problem? And it probably seems obvious, but really try to go for solving a very big problem, right? So first thing, can you explain what problem you're solving? Do you have existing customers? Know your market. What I mean by that is, what is the total available market? You'll hear investors talk about TAM, T-A-M. What is the total size of your market? And do you know how much of that market you're going to be able to achieve? Is it 2%? Is it 3%? Obviously, if you think about it, it needs to be a large enough percentage that investors think it's an interesting opportunity. You also have to have, right? It has to be large enough where you're going to get the interest of larger businesses that might acquire you someday. So you want to try to go after a large problem if you can, and you want to make sure that the market for your product or your service is sizable, and that will help reduce the risk. And then, when you're thinking about your growth, one of the first things investors think about is I understand this is a big market. There's a good opportunity to be profitable here, but how do we grow the profitability of the business? How do you scale it, right? So do you know your unit costs? How much are your unit costs to make your product or your service? Do you know how you're going to expand your gross margin? And I'm getting in the detail here, but it's really important to know. Investors want to understand that you have a very granular understanding of not only what it takes to make or deliver your service, but how you're going to achieve that scale and how you're going to do it profitably. So for example, if you make a product and the market size is huge, if you had access to capital, if we gave you capital today, would you be able to lower the cost of the development or the manufacturing of your product? And the answer would be yes, you hope you would, right? So you want to be able to lower your development costs to scale into that growth, and you want to be able to increase your profitability that way. So when you're talking to US investors, your costs to develop your product today are probably higher than they will be in the future. So you want to make sure that you're very clear on what it takes to build your product today, and then what is it going to take to build your product tomorrow. You want to demonstrate that you can be able to reduce costs, most likely, in the development of that product, right? The other way to say that for you more business savvy folks out there is make sure you can demonstrate how you're going to expand your gross margin. It's an important area.
Josh.
Yes.
Hi, sorry for interrupting, but you told us to let you know whenever there were questions.
Yes.
Cool. And it's related to what we're talking about. So I'm just going to read it for you, okay?
Yes.
It says, Oscar Salazar asks, how much market does a business needs to reach in order to be appealing to investors?
He refers to the size of the market.
Right. Understand. So look, that's it's a tough question, but you want to try to be at a minimum $1 billion, right? A $1 billion market at a minimum. But really, as you get bigger, it's between $1 to $10 billion of market size.
But I guess the question was referring on how much does the business needs to be already, selling, or how much market does the business needs to have already reached in order for you to invest?
I understand. So I think let me clarify your question. So I think your audience is asking, what size do they need to be in order to be appealing to US investors?
Yes.
Okay. So I'm going to answer that a couple different ways. It depends if you're an early stage investor or you're what's called growth capital. You're a little further along. You're like, and you know, I would say most US investors who are looking at backing maybe a Mexican entrepreneur, I would say that you would probably want to be, you'd have to show a path to profitability. So the most important thing is you need to be selling the product today. You need to have customers. I don't think you have to be profitable yet, but you have to be able to sell to customers. So I would say you should probably have, let me think about this. You know, you need to be probably doing over $100,000 in sales. I would say that was a good start. And, you know, you should be able to capitalize that and grow really quickly. So if you're $100,000 in sales, you need to also show that you can grow that, you know, at least probably 3 times as fast each year for the next 3 or 4 years. And that's really small. You need to get into the millions of dollars, you know, probably by year 2 or 3. So that's for kind of early stage venture capital. Later stage venture, or what a lot of people call private equity, obviously that's millions of dollars, right? That's in excess of $10 million. But I don't know if that's really what we're talking about today. Does that help answer?
Yes, thank you.
Okay. So one of the key things is, you know, you can have a really good product, you can have a good service, but if it's not able to scale, you'll be less appealing. So what I mean scale is, we talked about early, make sure you can demonstrate that you can lower your costs and at the same time, increase your market share. That's called scaling into growth. Make sure that you can demonstrate to them, provide confidence that you have a plan in place, you have a marketing plan in place, and how much it's going to cost you, right? So we talked about the growth plan. How does the business scale? You're going to reduce your costs. You're going to grow into the market. You're going to access that growth and make sure you have a plan to do that. And if you can show that, you'll get folks really interested in your idea, because investors want growth. And the reason why they want growth, I think, is obvious, but they're thinking about their exit strategy, right? Investors, most likely, a successful investment will yield either an IPO, an initial public offering, or another business will buy your business. That's most likely what will happen. And most venture capital investors in the US want to be able to exit their investment anywhere from 4 to 8 years. So you, as the entrepreneur sitting there today, if you're thinking about taking on US venture capital, if you're seeking venture capital from the US, you need to know that we are looking to invest in your company today, but we need to get out of that business anywhere from 4 to 8 years. So your growth plan needs to scale to that time frame. So if we invest today, we need to be able to get our money back inside of between 4 and 8 years. So you should use that, and you should go backwards into time and kind of engineer your business plan to achieve that exit. So I think that's what, when I talk about how does the business scale, understand you need to get to a large enough size where you can either sell your business, or if you want to keep your business, find a new investor that's willing to buy out the old investors. And that new investor will be a larger investor who's willing to pay a higher price. So think about that kind of in the beginning when you build your business.
Sorry, Josh?
Yes.
Here we have a question.
Yes.
Well, we have 2 questions, but we're going to start with the last one. Why this gap of 4 and 8 years? Why not a longer time, or why not a shorter time? Why this gap between 4 and 8 years?
Yeah, it's a really good question. And this is one of the most frustrating topics that entrepreneurs have to deal with. So 4 and 8 years. So here, let me explain it this way. If you're looking for venture capital investment, most of those investments, most of that capital comes from investment funds, venture capital funds, okay? So a venture capital fund typically has a legal life of between 8 to 10 years, meaning they go out to the market, they raise money from other people, and they tell those investors, we're going to give you your money back in either an 8-year or a 10-year time frame. So those are 10-year lives. So once they invest all the capital, once they raise that money, that venture capital group then goes out and finds entrepreneurs that need capital. But that venture capital firm knows that they have to return their money to their investors in a, let's call it a 10-year time frame, right? So if you're the entrepreneur and you want to seek capital from me, know that I'm going to need my money back in an 8-year time frame at the longest. And so to answer that one more at a more granular step, most venture capital funds have 2 different periods. The first period, which is years 1 through 4, is called the investment period. That venture capital fund is making investments to folks like you today. And then after the 4th year, they're starting to harvest investments. So that's the second piece of the time frame for a venture capital fund. The first is the investment period, and the second is the harvest period. And the harvest period simply means that venture capital fund is selling that investment or getting out of it. They're either helping that company become an initial public offering, an IPO, or they're selling the business to someone else, or they're finding a new investor. So those are the 3 ways. We're going to talk about that a little bit later. So that's why. Now, that's why there's a time frame, right? So all investors need to have an exit strategy. It's really important that you know that. And most investors want somewhere between a 5 and a 7-year time frame. And so that's why I just told you 4 to 8 to fit within that parameter. Now, there are cases where you can go and find investment capital from families or other institutions that have longer time periods. That's much harder to find. And think about it. Every investor needs their money back at some point. So if you can find a different way to get their money back in a period of time, that's helpful. But they all need their money back at certain time periods. And so the industry is really focused on this 8-year period of time. So that's hopefully that is there another question?
Actually, there is. There's one from, okay, there's one. In Mexico, it is not common to give equity to the team. Do you think this is a benefit or a problem, and why?
So if you're looking for US investment capital, it will be a problem. Investors are investing in the team. They're not investing in just one person. And if you're the person with the idea and you're the founder, you obviously are a very important person if you can execute well. But what happens if something happens to you, right? There's something called key man risk. One, if none of the other team is incentivized, what's going to keep them incentivized working for you, right? There's a risk to the business that the business won't sustain, that the business won't go on if something happens to the entrepreneur. Number one. Number two, they might be recruited away by your peer, your competitor. So it serves two purposes. It mitigates risk for the investors, but it's actually a best practice. There's a reason why the US capital markets are a leader in the world, is because at least to date, they found a pretty decent way to incentivize team members. And so if you want to have US investment, I would suggest that you think about changing your structure. Now, there are different ways, and you don't always have to just give equity away, because equity is very expensive, and we appreciate that. You can do, you can create synthetic equity or profit sharing, right? So I'm not sure how deep you want me to get into this, but you could give profits away, not in perpetuity, but for a certain period of time. The point is, you want to demonstrate that you have a vested interest in your team, in your employees, and that they're going to stick with you, because it's going to take the team to get the job done. So I understand that in Mexico, equity is not always given out. But I think in the US, at least for your top management team, it's something that is straightforward, and it would be a red flag if you, it would cause concern, I think, to investors if you weren't willing to share that with people, number one. Number two, honestly, you won't be able to recruit the right people on your team. At least here in the United States, the only way that you can recruit top talent is by making sure that that top talent has a chance to participate in the rewards if the business does well. That's a really interesting question, and I know it's different from how a lot of people think, but there's different ways to incentivize employees. And by the way, I'm not suggesting all employees need to have equity, but I think the management team does. And I mentioned before, if you're uncomfortable with pure equity, you can create more complex synthetic equity instruments that allows the management team to earn a unit or a share of the profits that might look like equity. But if that employee leaves, maybe you can take that back. And so they're more complicated, but there are certainly ways around them. So I'm going to move on to kind of internal systems. I think in today's day and age, I think most of you know that the cost to have really good systems have come down quite a lot, right? With cloud-based systems, whether you use Amazon's AWS or Microsoft Azure or Google's Google Cloud. But those technology platforms provide a tremendous amount of systems for managing your internal systems and for data collection, which is important. And it demonstrates to investors that you have a contemporary understanding of how to access data, use data, and that you're going to be able to manage your business with kind of the best in class, most contemporary methods for getting key data anywhere your business, customer data, internal systems data, product use data, and be able to share that data with your employees or with key stakeholders and certainly investors. So with cloud-based systems now, right, there's cloud-based accounting systems, there's cloud-based reporting systems. I would make sure from the very beginning that you look at that and you can scale into that. You know, there's companies out there like Workday that you probably know of to scale into these web-based services where you can access these typically very expensive services have been reduced in cost quite a bit. The other thing it does is it provides you kind of a dashboard. The entrepreneur is a dashboard of how my business is running every single day. You should be able to have data at your fingertips when you need it. Certainly investors are going to want to know at any time, how are things working, and you want to be able to provide them key contemporary data, and there's really good systems today to do that. The other thing is you want to be able to let investors know early in your relationship that you're going to communicate with them, generally frequently, at least probably 4 times a year, sometimes more. And if you can communicate using hard data, that's the most important thing. And it won't take too much of your time if you use some of these new cloud-based systems. And there's investor portals where you can upload documents to the portal. They have their own username and password, and they can pull down documents. Obviously, you know about all this stuff, but I'm just suggesting that it's really important to have a good handle on your business and invest early on in accounting systems, reporting systems, and HR systems. You used to have to wait till you're much larger to do that, but with today's technology, you can access those systems much easier today. Then the last thing, right? This is kind of what we're all waiting for. How is it that the investors are going to get their money back? And equally important, how are you as the entrepreneur, how are you going to actually realize success? So one of the things you need to think about is, well, what if I don't want to sell my business? You certainly don't have to. You just need to find a way to get the investors' money back. And the way I would think about this is you should have probably at least 3 different exit strategies, right? Think about it. The first one is probably the hardest to achieve, but there's the initial public offering. There's different ways to do that today, of course, and you're all familiar with that. That's the first. It's probably the hardest. The second, and more likely, is that you will be acquired either all or in part by maybe an industry competitor. Maybe a larger competitor will buy your business and you will still run your business. But make sure you understand kind of who are the likely candidates to buy your business. Are they your competitors? Is it a different market segment? So you should have a plan for that, and you should be thinking about that because investors will want to know. And then, of course, a third way would be a larger private equity firm will come out and buy your business. So the difference between the second option and third option, the second option is called a strategic acquisition, where one of your industry participants buys your business. The third option, when a private equity firm buys your company, maybe for 51% or 60% or some majority component, that's called a financial exit or a financial acquisition as opposed to a strategic acquisition. And those are the 3 ways. Now, there's also a 4th way that's harder to do in an early stage businesses like yours, is that you can pay the investors out along the way. Maybe your business is so good today that it's profitable and you're able to pay the investors back inside that 10-year time frame every year, right? Your company is earning profits along the way, and so you're able to earn those money and then pay those investors back a little bit, and maybe over 10 years, you're able to pay their investors back with a return. So that is a 4th way. It's typically the most unlikely way. It's very hard for a new business to generate enough profits early in its stage to actually pay investors back, but you should definitely consider that. So those are the 4 kind of ways, the 3 main ways, and then the 4th way. And when I talk about paying investors back, you should know that most investors probably won't start looking at your business unless they think they can make at least 2 to 2.5 times their money back inside that, 8-year term. And ideally, they'd like to see their money back in 5 years. So, if you think about it, roughly using an IRR calculation, right? Internal rate of return, a 2 to 2.5 times your money translates to about a 20% return for investors, an annual return. So If we go backwards, investors need to make at least 20% return on their money for high risk investments. And if you're going to have their money for between 5 to 6 to 7 years, then you need to be able to, pardon me, you're going to need to be able to give their money back in about 5 years in order for them to make about a 20% return. So that's what they're looking for. Real successful entrepreneurs and investors, as you know, make anywhere from 5 to 10 times their money. And that's obviously what you're looking for. So one more time, if you think about a venture capital fund, venture capital funds usually have in every fund one business that makes 10 times their money and 3 businesses that make 2 to 2.5 times the money. And then the rest of the investments, maybe there's 3 or 4 investments that just kind of break even. And they're usually 1 or 2 investments that don't make any money. So in order for that whole venture capital fund to work, for the investors that invested in that venture capital fund, they need to underwrite and they need to look at your business and know that they can make a 2 to 2.5 times their money, basically on average. So that's what you should be thinking about, that the exit strategy that you're demonstrating to them, that you're communicating to them, will show a 2 to 2.5 times their money. All right. And then I'll wrap it up here fairly soon. I'll go over, this is an example of a deal that we've done where we had a good result. So this was a case where we were early stage investors for a cybersecurity software company. And as you imagine, that's a pretty hot topic today, but here are some of the key topics. So one of the first reasons why we were willing to look at this investment was because the founder of the business had already sold 2 businesses before. So he had a track record of already making money for investors in the same industry. Now, I know many of you probably have not done that yet, so don't let that stop you. But certainly it was very helpful that we knew that this founder had sold businesses before and had a track record of making money for investors. And so that was a positive signal for us and enabled us to keep doing our diligence with them. And then after that, we looked at the management team, and each of the management team had really deep experience in the industry. They came from different parts of the industry, but they were deep in the industry and they came from different competitors. And so the CEO was able to recruit a really solid team of strong industry experienced folks. Third thing was this business already had customers. So we weren't just investing in an idea, we were actually investing in a product that had been market tested and that customers were already paying for. And so we were able to kind of de-risk our investment that way. We knew that some customers were already buying the product, and so we also were willing to put more risk in it. Right, the market accepted it. The market opportunity was very large, right? The TAM, the total available market, was, in excess of $10 billion. And so we knew that if it was successful, that the exit strategy would be fairly sizable and worth the risk we were willing to take. The management team had good incentives. We talked about this earlier. The management team had good incentives and proper alignment with investors, meaning that the management got paid more as investors did better. So obviously not just the CEO, but the rest of the management team, about 10 different other folks in the management team, also got paid with equity. And so when the business sold, they all did well. But more importantly, they saw the light at the end of the tunnel, and they all worked very hard, and everyone's alignment was fully kind of coordinated to make sure that everyone was doing everything they could to maximize the value of the business. And the only way that we felt comfortable was to make sure that the management team also were going to share in the rewards if this business did well. The next thing was the company had really good accounting systems, and they had very good investor reporting systems. Whenever we needed information about the company, they could provide it to us right away. And they gave us kind of login information, and that was helpful. Thirdly, or I guess lastly, is we had 3 different exit strategies. We had we ended up selling the business to a strategic investor. And that was very helpful. But we also had an IPO pathway, and we also had a pathway where a larger private equity firm wanted to buy the business. So as investors, we were able to work with management to help find the best way out of the business and maximize our value. So, but we saw that going in. The founder laid out to us the 3 different pathways. It was IPO, it was strategic acquisition, or it was private equity buyout. So we knew the investor was never going to be able to, the manager was never going to be able to pay us out along the way. We knew we were going to have to wait till the end to get paid on this, and we were okay with that. And so those were the key components of what we thought was a really good deal when we underwrote the deal, when we decided to invest, and it turned out very good for all those reasons. Okay, the bad news. We've had some winners and we've had some losers as well, as you always will. We did a deal in clean energy, and we were taking actually some food waste out of New York City, like tons and tons of food waste, and taking that food waste and turning it into energy, which is pretty interesting. And we thought it was a really cool idea. It was working in Europe, but no one had done it here in the US. So we decided to take a risk on that. The problem was that even though the management team had a really good plan, they had very little industry experience. They came from a different industry, and they thought they could translate their experience from one industry to a new industry. And that turned out to be a major risk for the business, and one of the key reasons why the business failed. The second is that the business founder never had a track record of making money for investors. They came from a different industry, and although they were successful in general as people, they didn't have any track record to demonstrate that they actually made money for investors before. And so that was a red flag for us that we should have paid more close attention to. This was also an early stage business. The product hadn't been made yet. We knew the product worked in Europe, but we didn't know if it was going to work in the United States. And so we understood that risk, but we didn't underwrite it very well. And so it was just an idea, and it was not one that I would do again. The other thing that there is regulatory risk. And in order for the business to succeed, we needed to have local governments provide us with certain permitting in order for the project to go forward. And you want to try to avoid as much regulatory risk as possible, because that's something you, the entrepreneur, can't control. You can control your product. You can control how the market accepts it by changing it. You can control how much money you want to raise, but you really can't control the regulatory risk. So that was an area where we really missed the regulatory risk on that. Third, it took a lot of capital to get this project to work. It was too much upfront capital, and there was no way for us to shortcut that. So we thought the investment might be successful, but we had to put way too much money in upfront, and then things didn't work out right after that. So it had too much capital upfront, and there was no successful product to start. The last thing, and this is something for you as entrepreneurs to be cognizant about, is that the investors weren't all aligned, meaning we were one party, there was another party in the deal as well. And that other party, when the business started to fail, we were going to continue to try to work it out and bring it back around and put more money in it to try to kind of solve the problem we created for ourselves. But the other investor did not want to do it. they wanted to take a tax loss. So in the US, probably in Mexico, if you take a loss, you can write that loss off. So the investor group wasn't even aligned. So just some advice to you entrepreneurs, make sure when you're working with your investors that the investors have alignment and that they all have the same goal. Lastly, we had to actually write the business off because there was no exit really. There was one exit, and when that one exit didn't realize, when it didn't happen, we didn't have any other options to sell off the assets. So we really limited ourselves by having just one investment exit rather than multiple investment exit options. So I'll stop there and see if there's any questions.
Okay, Josh, actually we have a couple of questions. Both of them can be connected. So I'm going to read the first one and then the other one that is connected with the previous one. Most of the entrepreneurs in this audience already have customers. However, our customers are located here in Mexico, here in our country. Some of the companies on this audience are planning to sell their products in the US, exporting them to the American market. And is that an interest spot for an investor? Even though they're not selling to the US, but they have established market here in Mexico. And which type of companies are you looking for? And the other one, speaking about you, at this moment, is your company financing projects here in Mexico?
Okay, so yes, if you have customers in Mexico, I think it's a really good start, right? It takes that risk off the table. I would try to point to some type of research that you think your product would be accepted in the US. It most likely would be, but I would say, no, you don't have to have customers in the US. And in fact, you want to work with investors that can help you do that. So there are some investors that actually can help you create different channel opportunities in the United States. And so keep an eye out for that. So yes, you don't need to have existing customers in the US. If you do, that's a plus. It's certainly much easier. The most important thing is you need to demonstrate that you have a path to the US and you have a plan to bring that US customer base into the business. We continue to make cross-border investments in different countries. We typically work with other investors or entrepreneurs that we've known over time. It's a lot harder for us to invest with folks we don't know because there's so much risk already for us. So we typically don't invest in Mexican businesses with folks we don't know or teams we don't know. Obviously, you know, there's always exceptions to that. We look for new investments today, we do, but they're in those categories I explained earlier. So we focus on real estate, we focus on software, we focus on fintech, and we focus on lending. So we do some fintech lending as well. Now, the other area is biotech. We have a biotech channel today that we started about 5 years ago. So those are the 4 or 5 areas, and happy to provide some guidance on any of those 4 or 5 areas in that area.
Josh, you said something before about agriculture.
Yeah.
Is that correct?
Yeah, so the agriculture we do is, so we work with a lending, we invested in a software lending platform in Mexico. Well, it's in the US, but it lends to, it allows agricultural distributors and US investors to meet on a platform and invest. And so this is a company called Produce Pay. I don't know if you all know it. but it allows farmers in Mexico to pay for their labor on the earlier side of their harvest period, when there's not a lot of cash flow available, to buy seeds and to pay for labor. And the platform allows to lend to not only source those deals, allows to lend against those deals, and it bridges capital. So agricultural providers or farmers meet on this platform with US investors. And that's been a very good investment for us in Mexico. We've also done some lending in Mexico as well, just direct lending. So I think with that, I've kind of concluded my general comments, but I'm happy to continue and answer questions, either on anything I said or anything else.
Well, there's one more question here that says, I'm going to read it to you. Says, in your experience, Mr. Roach, how common is it for investors to dive in wholesale and resale project of agriculture commodities or products for, say, superfood grains?
Yeah, I mean, I think do US investors have an appetite for agriculture today? And I would say, yes, I think they do. So I think it's important, and we know a little bit about that space, and I probably have a lot more connections in that channel. But yeah, that's an important area, and we'll continue. I mean, understanding kind of the supply chain of agricultural is important to people today in the US. They like the sustainability aspects of it. They like the impact, right? You're investing in agriculture. It's helping not only the people growing the product and the local communities there, but also the people consuming the product. If the product's being consumed in the US and it's an agricultural product, and if maybe it's organic, maybe it's not, it's going to sustainable sources, both on the input side and on the output side. So we see a big trend in that area. And now with platforms like Produce Pay and other fintech programs, you can much easier connect the agricultural providers and the capital providers in one place to kind of make it much easier to increase the supply chain here. I would say one last thing. We spent a lot of time today talking about venture capital and venture capital funds who have that 5 to 10 year time frame that I mentioned earlier. There's also another group of investors called family offices, and they're a little smaller than venture capital, and they can be more flexible. So it's harder to find these family offices, but it might be an interesting place for you to start. If you're an early stage business and you need a little bit more time, then consider working with, in the US, we call them single family offices or SFOs. And they are like venture capital, but they're maybe not quite as strict with their time frames. And sometimes they're a little bit easier to work with. So oftentimes family office investments, they come in first in the first stage of an investment, and then a venture capital fund will come in at a later stage. And so you might want to consider seeking investment from the family office world. And that's harder to find, but there are people, even on this call, that that you're working with here, that Claudia can be instrumental in helping share more information on how to think about accessing those markets.
Sure. We have a couple of more questions. I don't know how are you on time, Josh? If you can.
I'm okay.
Okay, cool, perfect. Well, the last one was, what aspects are needed to be able to sell a product to the American customer? A tricky one.
Okay. Maybe ask it again in a different way. What are they trying? What's the question?
It says, what aspects are needed to be able to sell a product to American customers? I think what it says is that, what do you have to take into account when selling a product to Americans? It's to American customers, sort of. I think.
Well, I would ask whoever's answering the question to clarify what industry or what product you have in mind. And in the absence of that, I'll do my best to try to explain your question or answer your question. I don't think there's any magic to this. It's, if you are solving a problem, there's always a market, right, to a problem solving event. If you're providing a service, and you can provide the service at a cost that's better than what they can get today, or you can deliver the service or the product in an easier way, then there's a market for your product. I don't think it matters where it comes from. I don't think it really matters that the product comes from Mexico or the service comes from Mexico. It's, does the product work? Number one. Number two, does it make sense economically for me to use this product or service? And does it make my life easier? If you can answer those three questions, or at least two of those three, you have an American consumer as your customer. So that's what I would say. Americans are consumers. They like buying things that make their lives easier and better and healthier. And they're open to buying products from different markets, right? I mean, most of our products are consumed in the United States are from outside markets. They're not from the US, as you all know. So.
Yeah, I think that covers the question, Josh.
Okay.
Thank you.
All right.
There's one that's related to software. I'm going to read it to you and then maybe just like try to translate. Josué says, I represent, well, si alguien quiere hacer la pregunta en ellos con su micrófono, adelante, ¿no? Lo estamos leyendo porque está en el chat. So Josué says, I represent two firms. One of them is about software. Okay, cool. He says that he wants to ask it. Josué. Dulce, si se le podría abrir.
Hello? Could you... Okay, thank you so much. Well, nice to meet you, Josh. I'm Josué. I represent two firms. One is about software. We bring services as software as a service, focusing more on BI and data analytics also. Its name is Banana, but I also represent, well, I'm part of a firm that is about investing. So you bring money, we bring you, well, in Spanish it's called rendimientos. I don't know how will be exactly the word of English, but basically we give a small percentage about the money is in your account to basically as investing basically. And I want to talk to you about both of them if you are able and if you give me permission also, but not at this moment, just as a presentation, because I have already done this before, like asking for investments or also presenting the two firms. And I will ask you for a date in order to present you both of the options and the ideas in order to develop a good deal. Well, as you call them, like a bad deal and the good deal in order to represent as good deal?
Yes, I would direct your question to Claudia and her team, and I'll take my direction from her.
Thank you so much.
Welcome.
Thank you so much.
Perfect. Hold on just a sec. Well, there's another question, Josh. Just let me know, your time, and if we keep, going
no
with
problem.
It says, Miguel asked Josh, which company do you recommend to carry out market research for real estate project in Mexico?
So someone's asking what U.S. company should do market research for a Mexican real estate project?
I think that's what he's saying. If not, just
okay. I don't think that matters. I'm trying to think. I presume that. So if the person asking the question is considering a real estate deal in Mexico, then they should use a Mexican research firm, not a US firm. I don't, in real estate, it's not typical that you use a research firm. So none of our real estate projects have we ever used a research firm. We do our own research in the market, and we invest on it. So I'll give you an example. There's a firm in the US called John Burns Strategic Consulting. Our focus has always been residential real estate, right? So houses, homes, apartments, right? Residential real estate. And the John Burns kind of realty research does a lot of work for us on just general research of the market. But other than that, we buy their reports, but we really know at a market level what's available. Having said that, there are brand new companies out there today that you can get so much data on in real estate in the US market, though. I don't know how that translates to Mexico, but there's all sorts of real estate fintech, a lot in Europe. I think it's called prop tech, property tech today. And there's a lot of good firms that give data on research, but the most important thing in real estate is that you've done it before and you know how to manage it. Although real estate is a simple, it's a hard asset. You can build it, you can see it, you can touch it. It's great for inflationary purposes, but real estate projects can really turn out badly very quickly if you don't have experience doing it. So we don't ever invest, for example, with someone that has never done real estate before, because you need to make sure in real estate that your projects are on time and on budget. And it's very hard in real estate to manage those two things together, to make sure your project is on time and it's on budget. If one of those two things goes the wrong way, you have likely a broken deal. So we're not interested in taking risk with folks that haven't done that before. And so obviously the people we are doing it with have experience doing it. And so there's not a lot of research that they typically need. But to answer the questioner, we like John Burns Real Estate as a general piece of research, but it's not project specific. It's more macro research.
Thank you, Josh, for all the information. We have to say goodbye. Alberto?
All right, Dulce, thank you. Josh, we want to say thank you for your time today, because it was a really interesting topic. I mean, investing and all that related stuff for entrepreneurs that are looking for a quick impact, or they want to have this growth using the investments. It's a really exciting topic for people that are looking for evolving as a company. So it was really interesting, and we want to say thank you because you participated here in Crossing Borders. It was a really nice talk with you. And for the people that is attending this webinar, you will find it, I think Dulce is going to be on YouTube also, or not?
Yes.
Okay, so you will find it on YouTube also in the channel. And we want to thank you, Josh, speaking for the Secretary of Economy, Javier Lizárraga, and the Undersecretary, Moraima Yassin. Thank you for your time. Thank you for your knowledge that you are giving us today. And for the people that is here right now, we want to say thank you and see you next week in the next webinar of Crossing Borders. So thank you so much, and see you soon, my folks.
Okay, thank you.
See you,
Bye-bye.
Josh.
Thank you, Josh.
Thank you.
Thank you, Josh.